REIT, or Real Estate Investment Trusts, is a special type of unit trust that invest 50% of its total assets in real estates. REIT is constituted under a deed between the manager, the trustee, and the several persons who acquire units in the trust. It is a form of scheme for the pooling of resources into a fund for the purpose of investment in a certain asset portfolio. REIT is also known as Property Trust Fund, and it must be approved by the Securities Commission. The basis period for a YA for REIT will be the financial year end, which may be 31st December or non-31st December. Rental income from the letting of real property is a business income to REIT. Any outgoings and expenses incurred in respect of the business are deductible. However, the excess of expenses over income is not allowed to be set off in the current year or in the next YA. The excess of capital allowance in a YA also cannot be carried forward. Since REIT is a special type of unit trust, thus, the exemption available to unit trust is also available to REIT. For example, foreign source dividend income, or dividend income received from Malaysia company out of exempt income account is not taxable. Interest income received from financial institutions, which are licensed under the BFIA 1989 or 1983 are also tax exempted. To boost the market on REIT, the Act specifically exempts REIT from tax on its total income if it distributed 90% of the total income in that YA to the unit holders. Expenses incurred on consultancy, valuation fee, and legal fee upon setting up a REIT is tax deductible in the YA where it commences its business. A company disposing industrial building to REIT, where initial and annual allowances have been claimed, will not have any balancing charge on such disposal. All instruments of transfer of real property to REIT or property trust fund approved by the Securities Commission will be exempted from stamp duty, where a REIT distributes income to a unit holder, other than a unit holder which is a resident company. Tax need to be deducted first. The net distribution is paid to such unit holder, and the tax deducted shall be paid to the Inland Revenue Board within 1 month after distributing such income. A non-compliance will result in a penalty of 10% of the unpaid tax, and both the tax deducted and the penalty are debts due to the government. In a nutshell, the tax incentive provided to REIT is expected to boost up the development of REIT in Malaysia. It is hoped that REIT will be able to reap a higher profit from this, which in turns pays a higher dividend to its unit holders.